Hello, everyone. Welcome to Smart Investing. I'm Albert, the host, like always, and today this video is going to be about the banking services sector. This is the continuation for this sector. Excuse me. So, I have about 10 stocks that we're going to go over. Again, it's in no particular order as of market cap or price or by name. We're just going to go over these companies and we're going to review them financially. And what I mean by that is we're going to go over the fundamentals and a little bit of technicals. So again, I'm using Webull and we're just going to do, like I always do, the evaluations. So for this list, it's much shorter than my usual list. So let's just jump right in. The first one up that I have is ECPG. So let's look at this. So we have here decent earnings, very undervalued for the PE. I love using PE. That's the metric that I use. I do know how to use other metrics to evaluate companies. I just prefer PE. If you guys want me to change the evaluation method, I can do that. I'm just no expert on it, but I just know the basics. So if you guys have any questions or feedback, obviously I'm open to it. Maybe you guys can teach me a thing or two also about price book and price to sales as well. I've seen other videos as well, and it just doesn't stick with me as much as the PE. So I have to expand on my evaluation metrics and methods. So that's always a good technique to use as well. I just have to also keep in mind of what numbers are normal. What I mean by normal is that I always want to see something where it's either overvalued, where it seems fair, or it seems undervalued. So when people evaluate companies, they also say other methods, and people have other methods and analysts as well, and teaching you different terms as well. I don't think I've ever explained this, but it's just real quick. Some people use terms like overperform, and just regular performing, like on target, or underperform. That's the same thing as saying overvalued, fairly valued, or undervalued. Same thing as saying as overbought and oversold. I forgot what the middle requirement is for that terminology. But also the obvious one is buy, hold, or sell. And those three signals as to evaluations, they all mean the same thing. And I know when people start first investing, they all mean the same thing. It's just worded differently. And again, everybody has their own words to choose from as to what they say when they speak. So I just don't mind whatever words come. But I usually just state the obvious ones. I usually state the most basic ones, which are buy, fairly valued, or sell. Or I usually say overvalued, fairly valued or undervalued. Those are the terms I like to use. But anyways, moving on. Let's just evaluate this. And let me just move my camera a little bit so that way it's not in the way too much. So we have here, okay, so I did have the numbers here. So they do look like a good company so far. We have here volume, somewhat. So I like the chart right off the bat. I like to see uptrends. But again, when we see uptrends, you want to see what is the price difference for that. Oh, sorry. My line is not as straight as it should be. But we can always adjust that. So we're looking at a 52-week high and low of 72 high, 37 low. That gives us a difference of about at least 33 bucks and change, guesstimating. So that leaves us $33 for the year. That's an okay capital appreciation for the year. Something like that, I'd say that would be a good return for half of the year, but something's better than nothing, I guess. And as we can see here also, the last month. Well, let's look at the last 3 months so that way you guys can actually see the downtrend. Because we see that downtrend starting from about mid-February to late February. So the exact date that I have is February 18th. So that was a few days before the earnings or same week. Let me see. So from the 18th, 19th, 20, 21, 22. So pretty much the same week when they reported earnings. After earnings, obviously the stock dropped. So now we look at the 1 month. So the 1 month it's gone down at about, where was it? We're looking at least 5%. That doesn't seem right. That doesn't seem right. From 70 all the way to 62. I don't know. I can't do the math, but the difference is about. You're looking at about. See, some people do percentages. I do not like. I rarely do the percentages. Only sometimes when it's gains, but really it's just, I don't know. I just prefer the dollar amount. So, the 52-week high and low is not based on percentages. So it's just, I just see it as more accurate. And it's just a better evaluation to see actual numbers in dollar amounts instead of percentages when I do these. So we're looking at least about a $10 loss for the month for this stock. So let's look at the last 5 days. Pretty choppy. Moving on to the next category. Let's look at the evaluations for it fundamentally. So good. We have 2021 results as projected. Now let's dig deeper a little bit more. It looks like they have beaten earnings the last 4 times, which is good. Return on equity has gone up from last year at least. I'm looking at about at least 11%. It's really, really good. We're looking at ROA up about 3%. We're looking at earnings per share up significantly. Pretty much doubled from 2020 to 2021. 2020 to 2021. They have lowered their debt. Even the last 5 years, looking at these numbers, really, really good. So from 2017 to 18, about 1%. From 82 to 79, down 3%. 79 to 74, a good 5%. About the same from 2020 to 21. Not bad. Looks about 0.75%. So within 5 years, we're looking at about close to a 10% difference down in debt. That's not too bad. Cash flow, they have gone up. And let's skim through that. So net income, one of my favorite categories to look at. So we have here a percentage of 40% year over year. We have revenue slightly down. We have 2020 to 2021 operating income has gone up significantly. So it seems like a solid company. They do have cash. We do have cash on the sidelines. So let me just see if they have ever paid dividend. It doesn't look like it. So, whoa, okay. So this is throwing me off. So this is basically not specifically a banking services sector. They do corporate financial services. So let's read a little bit about what they do. They do debt recovery. As we can see here, they do portfolio purchasing. It looks like they do a lot of debt obligations to credit originators, including banks, credit unions, defaulted receivables. So they are also in Europe, the UK, and Ireland. It looks like they do debt consolidation. So I guess when somebody goes, well, not individuals, but companies, it looks like when companies go bankrupt, they try to consolidate assets, I guess, and try to reassess portfolios. From what I'm gathering, I mean, they have several services, so it seems like they're pretty diverse in their strategy, which is good. That's always a good thing. But I'm trying to see what their main selling point is. What do they actually do? Like, I know they do several things, but what is their top of the line selling point is what I like to call it. What do they specialize in? I don't see any of that. It looks like they try to recover here. This is the only sentence that I see that's important. So they try to collect on defaulted receivables. It seems like as if when when a company goes bankrupt and when they try to consolidate their assets, they try, I guess they don't help them out, but they just collect on default assets. So I guess they work with them and then probably they sell some assets to them and then probably in return they reevaluate their portfolio. And also they do like it says they do like debt obligations and work toward financial recovery. So in a way, it sounds like they screw people over, and then also they help people at the same time. So If you want to put it in layman's terms, that's pretty much what they do. But if you really want to think about it, are they on the good side of things or on the bad side of things? Are they helping people more? Or are they screwing people over more? It's hard to say. But if they've been in business that long, they must be doing something right. I'll be on the safe side and say that um, I'll just say they're neutral. I mean, they haven't paid a dividend, so it seems like they're growing the company, reassessing, and looks like a solid company. I'd say this is a company that has room to grow. The chart looks nice, and their market cap is not bad. So definitely a watch list to that company. Moving on to the next one, NNI. So we have NNI at 84.99. Volume is pretty low. The chart is pretty choppy. 52-week high and low, a difference of about $20, give or take. PE is at 8.5, rounding it off. Undervalued, so it's not too bad. They do pay dividends quarterly, which is good. So it looks like they dropped definitely in January. That January effect for this year started off bad, trying to recover. It looks definitely like they're in line with the major index. Definitely. So this is definitely a watch list company. But let's look at the financials real quick. I'm going to jump into that. I do have 2021 reports, which is a good thing. Net income, we have year over year, they're up by 11%. Why says it down? Unless I'm reading something wrong. Why it looks like it says it's down, but then it says it's positive. I'm misunderstanding something. But let me look at the bar chart. So what I'm gathering is they slightly went up for their net income and slightly went up for their revenue. They went up 1%. A gain is a gain, so not bad. Even if they say the same, still saying, staying the same is still pretty good. Losing is when it becomes a problem, especially when it's consistent. So this is not a banking services sector stock. This is in the consumer lending. So again, in my other videos, like I say, it's a similar industry. It's a similar sector. They just, provide their services differently and offer different services. So we're looking at this stock, NNI. So let's dig a little deeper. We have here, let's look at their debt, which is pretty important. Pretty high debt, typical for a bank. Margins have grown significantly. I'm not really surprised to see that much for 2020 and 2021. So I think even for any bank, really, you just want to see cash flow. It's hard, and then also too, I know I've been evaluating on PE, but I hear that some people say, where I've read and seen, PE's PE is not a good metric to evaluate banks, but I do it anyway. I still think PE has always been solid for any company. Some people use either price to book or price to sales. Usually price to sales when it comes to banks, but I'll look into that again. And then again, there's always other chances and opportunities for me to reevaluate the same company to see how it does in the future, and then also to even use a different metric and compare and contrast as well. So net income has grown, revenue has stayed the same, operating income has slightly grown. It looks like they've remained the same when it comes to the balance sheet the past 5 years. Debt has slowly gotten a little bit lower, not too much. So what I'm looking at is this. I'm looking at the 21 to 18. Sorry, I crossed that out. So 21 all the way down to 18.7. So we have there $3 billion difference in debt, which is good. So it looks like they're just trying to get rid of debt and build some cash flow. So we have operating, investing, 49. It looks like they're trying to build cash flow. What are their earnings again? It's pretty strong. So let's look at the dividends, which I know a lot of people love dividends. I love dividends too. I'm not going to go too far back. We have history here. We have a log even dating back to 2013. I'm going to bump it up to 2020. So we have here in 2020, well, I'll bump it up a little further. Let's go back 2017, back to the 5 year. 2017 paying 14 cents, up in 2018 by 2 cents, up again 2019. Another 2 cents. So that's the trend. In 2020, paying 20 cents. In 2021, 22 cents. In 2022, the first payment was in February 28th. And again, they were up 2 cents. So it looks like they're solid. And they are raising their dividends every 2 cents. So we're looking at about an 8 cents raise per year. Comparing to other stocks, overall, it's okay. For the sector, I've seen better, but it's harder to find. But overall, when it comes to, how can I say this? It's like, when it comes to similar sectors and similar industries, so comparing to their peers and sectors, that's not too bad. That's not too bad. Definitely, this stock is compared to the index. Moving on to the next one, we have NICK, Nicholas Financial. So we have here the 1 year. That's really choppy. Looks like you're breaking even. A volume I do not like. Earnings, 52-week high and low of 12 high, 9 low. Earnings, not even a 1. They haven't paid a dividend. We have a 1 year. Hold on. We have the 1 year choppy. For the month of March, you can clearly see they have dropped like a rock. 11 all the way to, well, let's go, all the way to 9. It's a $2 loss, but that chart is pretty harsh. If you look at it, it's a really big drop. I say no to the stock right away, but I'm going to go over the financials anyway. So let's look at the 2021 reports or estimates, the details that we have here. So let's look at that. I don't have anything for their reported earnings if they beat or have missed estimates. They're not a likable stock. Let's just put it that way. They do not look too good. So moving on, the revenue has gone down. That's not good. Net income has gone up though. Their debt has gone down, which is good. It's hard. So let me reevaluate this, because now that I saw the balance sheet, At first I saw the income statement. Income looks kind of bad, but then when you look at the balance sheet, it looks like they're trying to restore their balance sheet. So we have here. I mean, it's hard. It's hard. It's hard. It's hard. This is what I see. Income statement versus the balance sheet. So which one is better for this stock? We have the income, looks like crap. Their balance sheet looks better. Let's dig in deep. Let's see here. So we have their return on equity. Past 5 years been choppy. From 2020 to 2021 has gone up. ROA has gone up. Earnings per share has gone up. Book value, net margin. So their net margins have jumped from about 5%, as we can see here, to 14. That's a difference of close to 10, which is good. Their debt, and this is not typical. First off, before I even say they are a bank, let me make sure they are a bank, because these numbers look like they're readjusting. They're doing okay. So again, the balance sheet looks good. It looks like they're getting rid of their debt, which is good, their liabilities. They also trim their assets, but if that is worth it to sacrifice their debt, that's really a good sign. Their revenue has dropped. That's still fine, but their income has gone up, which is really good. Let's look at their cash flow real quick, and then I want to see if they are still in the banking services sector. So we have 14, negative 36. They do have some cash on the sidelines, it looks like. So this stock, okay, the stock is not popular, but the company, I give it a few months to see where this leads. I say give it 2 quarters. I want to see how they report the next 2 times this year. And hopefully they have gotten even better. This stock might be a very sleeper stock. Meaning, this is very under the radar. And this stock can actually sneak up on people. Again, the last time they paid a dividend was in 2013. So it looks like they're readjusting and realigning their cash flow issues. Now let's look at, so they are not in the banking services sector. They are consumer lending. But either way, this company seems like they're trying to reevaluate their system. I'd say this company has potential. And it sucks because I'm trying to do banking services sector stocks, but then I keep getting on consumer lending stocks as well. This company, again, I don't know if I can say watch list or not. I would say watch list for now and keep it on the watch list for the year just to be on the safe side. That might be very, very useful. And that stock to me looks very under the radar. Very, very cheap, but they're just trying to reevaluate their company. So we have here next stock, GABC, German. What is that? American Bancorp. Let's look at the 1 year. Very choppy, awful. Volume is, I don't like it, but I could be wrong fundamentally. Short term looks like it's going down. Let's look at the 5 year real quick. No, doesn't look interesting. Let's look at the 2021. Yes, I do have 2021 estimates. Really good company. So it looks like they're growing revenue, income, earnings, everything. Debt is high. It's normal for a bank. I think I'm used to seeing that. Let's look at the dividends. Raising dividends, as we can see, ever since 2017. So we have a 2 cents raise 2018 and 2019. 2 cents raise 2019. 2020, 2 cent raise. So it looks like that's the trend. 2 cent raise every year. Any splits? They have one in 2017. So we have financial details. Let's dig deep again. So we have here margins. I don't have anything. Cash flow. Yep. Looks good. Revenue. Operating income. So for this stock, I'm going to have to say no. It's just the debt, and then the volume and that chart. I mean, look at that 1 year. It's just choppy. So again, that 52-week high and low. Again, this is just not a stock gaining momentum. That's all it is. That's all there is to it. And then we see a difference here of about $13. So moving on to the next one. LEVL, Level 1 Bancorp. So this stock is on a rip. Definitely add this to the watch list. You guys should definitely see what I see. That huge gain in November, even though it's flat. So we have here, they do pay dividends, nice earnings, decent volume for a stock, very small cap company. What else do they have? Everything looks good at firing all cylinders. They are a bank, finally. So let's look at the 5 year. Looking good. They're going higher. Definitely a stock you want to pay attention to. So now let's look at the report. So we have here 2020 and 2021. They're high in debt. So obviously 90% debt. And dividend raises. So we have here 2017. Let's look. Oh, I don't even have 2017. It's not letting me, guys. So we have 2018. So it looks like a penny. Looks like a penny that have been increasing, as you guys can see there. Paying about 6 cents. So I'm guesstimating the next payment will be should have been, I thought, in March of this month, but I guess not. Maybe it hasn't gone through yet. Maybe they have. But again, it looks like they should pay about a 7 cents dividend payment. Having trouble with my pen there. I know you guys are pissed about the dividend yield, the annual dividend as well. But again, even if you're not interested in the dividend, the chart looks pretty good. It looks like it's holding up. Definitely watch list this stock. Next one up that we have is Lcnb. So Lcnb 1 year chart has gone down. Wow. It's gone up then gone down again. So 52-week high and low. 52-week high of 20. 52-week low of 15. About a $5 difference for the year. That's not much. It's horrible. 10 PE showing that it's undervalued. Dividend yield, we have it at 4.56. Annual dividend of 80 cents. So if they're paying quarterly, they're paying 20 cents. I'd say no to this stock because, again, just the 1-year chart doesn't look like it's going up. I mean, it's gone up there, then it's gone right back down. So that only took 4 months. Well, actually, less than 4 months of gains, and that's it. You pretty much broke even if you invested in this stock for the year with a buy and hold strategy. So moving on, let's see the numbers for the details. So we have net income slightly gone up, revenue, let's dig deeper, 87% debt. We have mixed reactions for hit and miss for quarterly reports. At least they're positive, I can say that. So we have here returning about the same per year, not bad. For ROA as well. Net margins, I wish to have net margins. If not, I'll still use the net income anyway. That's still fine. I like seeing net. 2021, we have the debt has slightly gone up, and revenue has gone up. Balance sheet looks typical, like a typical bank. Operating, investing. So it looks like they have some cash flow. What market cap is this? A $200 million market cap. I'm still going to say no, but again, I'm going over it anyway. So again, yeah, 20 cents quarterly dividend for this year. That's what it seems like. And for the past 5 years, it looks like they have done a 1 cent increase. So 2018 here. So 2018 to 2019, 17 cents. Then the next increase is here. So 2019. So yeah, a 1 cent increase. Splits. They have done a split in 2007 and 2004. So I'd say stay away from this stock. I don't like it. Stock market doesn't like it. That's just what it is. And let's look at the name of this company. And let's just read what they do. Real estate loans, all kinds of loans. So there you have it. They do old school banking. I mean, look at this. They do safe deposit boxes, night depositories, bank by mail. I see words like that, and some of that is just like old-fashioned business. Everything is usually done online. But again, some people prefer the in-person method, I guess, for security purposes. That works too. To each their own. Everybody has their own preferences. But, you know, we're in 2022, guys. The digital method is usually the way to go. So last stock that I have is WRLD, World Accep Corporation. Doesn't look like they pay any dividends. That is a pricey stock at $191. Let's look at the 52-week high and low. That is like $140 difference. Really high. It's showing me it's fairly valued. And that's from a drop of, like I said, in the 250s, 260s. So yeah, it's showing me that it's fairly valued. If you look at the 3 month, it's gotten down. It's trying to break even this past month, but only time will tell. But if you move it on to the 3 month, it still looks like a downtrend. It still looks like a slow downtrend. I don't see any break going up. So even though this is flat for the month, I still think this stock is not paying a dividend. Is this even a bank stock? Consumer lending, so they do small loans. Let's dig in deeper. This is pretty expensive for stock, first and foremost. I'd say no. I mean, if you have money to burn, I mean, for its particular sector, for the consumer lending sector, this seems like a good stock. But comparing to other financial sectors, when you have like the banks, consumer lending, and then other banking services, and all those other competitors, and they're not paying a dividend, I think this is just lost me right there. So we're not paying a dividend, and then we look at the difference in the 52-week high and low. That looks like a growth stock. And again, I'm not knocking them down. I'm just saying it's just pretty expensive. Looks like a good company, but I'm gonna dig in deeper. That's what we're gonna do now. So let's see what they have. Earnings look like they have dropped for the year. I'm not surprised because 2022 is going to be a rough year. And they have gained a lot of equity in 2021. ROA, that's pretty high. Earnings per share. So their earnings have gone up. Wow, the net income has gone up. Their debt has gone lower. So don't get me wrong. I mean, this is a watch listed stock, definitely, but it's just expensive, like I said, and that's the only downside. They're not paying a dividend. So if you want pure growth, this seems like a good stock. I mean, they're a $1.26 billion company. So they're pretty good. But again, they just don't pay dividends, and they're just pretty expensive. I guess I'd say watch list. But it's just not a good time to buy this stock. They're still pretty pricey. So even if you bought at the bottom, right here back in March, let's look at the 1 month. So if you bought here, let's say at 163, you only made a $30 difference as of right now, which ain't too bad, but you still would have had to have gone through these little spikes to have gotten to that $30 difference. So this little difference here, let's look at that. That would have been a difference of and I'm just guesstimating, guys. So we're looking at about, that's a $10 difference. And there you have it. Those chops between those $10 difference. So that's all I have for you guys. That is all I have. Thank you guys for watching. I hope you guys enjoyed it. I know I took too long, but very important info. So we have here all these stocks. 1, 2, 3, 4, 5, 6, 7 stocks. Hope you guys enjoyed it. It is March 31st, Thursday, 7:30 p.m. And again, if you're going to invest in the stock market, please consult a financial advisor who is licensed and insured. I can't give any recommendations. I wish I could, but I can't. So any buy or sell recommendations, please consult somebody. So there you have it. Thank you guys for watching. Hope you guys enjoyed. I will see you guys in the next one.